Hey, welcome back to Fintelliq. If you have money just sitting in a regular savings account right now, I need you to stop what you are doing for the next 20 minutes because you are probably losing money without even realizing it. And here's the situation. In July 2026, the Federal Reserve, under its new chair, Kevin Warsh, just rose interest rates at 3.7%, 75%. At the same time, inflation is stuck at 3.5%. Sounds boring, right? I know. But that combination has quietly created one of the biggest gaps we have ever seen between what a normal bank pays you and what the best banks are paying you. So we are talking about a difference of 4 percentage points on $10,000. That's the difference between earning about $40 a year and earning over $4,000 a year. Okay, same amount of money, same amount of risks. Yeah, completely different outcome. That because of which account sits in. In this video, I'm going to walk you through exactly how this happened, which banks are paying you the most right now, and traps hiding in this fine print, and 3 real strategies you can use today to put your cash in the right place. Let's get into it. Let's start with the big picture in plain English, no jargon. For most of the 2025, the Fed was cutting interest rates 3 separate times, a quarter point for each time. Everyone expected that trend to continue into 2026. Then, out of nowhere, the new Fed chair, Kevin Warsh, stepped in and hit pause. Rates have been frozen since. Meanwhile, prices are still rising at 3.5% a year. That's inflation, and it doesn't care whether the Fed is cutting or holding. It just keeps eating into your savings either way. So here's the split we are seeing right now. If you keep your money in a typical brick and mortar bank, think the big national names with branches on every corner, you are earning somewhere between 0.38% and 0.62% per year. This is basically nothing. But if you move that same money into digital first, online only bank, some of them are paying you to 4.5% right now, and that's the 4.12 spread you see on screen. The gap between the worst options and the best options in the market today. That gap is really the entire reason I'm making this video. Managing your cash is not about defensive move anymore. Something you just do just to feel safe. In 2026, it's an active strategy that genuinely makes you money with zero extra risks. So let's talk about why this actually happened. Okay, let's talk about Fed, Fed, because understanding this makes this part, everything else in the video makes sense. Quick refresher. The Federal Reserve sets something called the federal funds rate. Think of it as the master interest rate for the entire US economy. When the Fed cuts that rate, borrowing gets cheaper, but banks also tend to pay you less on your savings. When the Fed holds or raises that rate, banks can afford to pay savers more. Though 2025, the Fed cut rates 3 times and a quarter point each time, bringing the rate down to that 3.75% level. Almost everyone on the Wall Street expected more cuts to follow in 2026. Instead, at the June 2026 meeting, the new Fed chair Kevin Warsh did something nobody fully priced in. He held rates completely steady unanimously, with the whole committee agreeing. But it's what came next that really matters for savers. Warsh also rolled out 5 new internal task forces on making the Fed more transparent, and when the committee released their so-called dot plot, which is just a chart showing where each Fed official think rates should go. 9 out of 18 officials said they actually want to raise rates again before the year is out. That's half the committee turning hawkish, which is a pretty dramatic shift. The actual bond market noticed immediately. Futures traders are now pricing in better than 50-50 odds of an actual rate hike by October 2026. So instead of rates drifting lower like everyone expected, we might be looking at rates staying flat or even climbing a bit for the rest of the year. Why does this matter for your savings account? Because banks that offer high yield savings accounts are constantly adjusting their rates to match what's happening at the Fed. A frozen potentially rising rate environment means today's high yields have real staying power. This is not a fleeting promo, it's a genuine window. Now let's get to one formula I want you to remember from this video, because it's the thing that actually tells you whether your money is growing or shrinking. So it's called your real yield, and the formula is that simple. Real yield equals your nominal interest minus inflation. Nominal just means the sticker rate, the number the bank advertises. Real means what you are actually walking away with once rising prices are factored in. Let's run the numbers together. Say you are using a typical national bank paying 0.38%. Inflation right now is 3.5%. 0.38 minus 3.5 gives you negative 3.12%. That means in real terms, your money is losing about 3% of its buying power and every single year, even though the account balance is technically going up. So you are just paying an invisible tax just for keeping your cash in the wrong place. Now flip it. Say you are in a top tier HYSA paying 4.5%. 4.5 minus 3.5 gives you the positive 1%. That's a real actual gain in purchasing power. Same amount of risks. These are both just savings account, but one is bleeding you slowly and the other is quietly making you richer. This is where I keep saying, where you park your cash in 2026, it's a minor detail. It's the difference between negative 3% and positive 1%. Just by choosing a different bank, let's look at exactly why which banks are winning this guide game now. So alright, here's the part you are probably been waiting for. Who actually pays the most right now as of July 2026? At the very top, Go-To Bank is advertising up to 4.5% APY. That's the highest headline number in the whole list. No monthly fees, no minimum deposit to open it. Right behind it is a newer name, Elevolt, paying 4.3%, also with zero minimum deposit and zero fees. Then you have got the Exos one sitting at up to 4.2%, but it does require a monthly direct deposit of at least $1,500 to unlock that drop rate. So this one really built for people with a steady paycheck going in. Forbright Bank and Everbank, though a network called Raisin, are both sitting right at 4.5%. Everbank's offer is actually a guaranteed rate for 90 days, which we will talk more about in a minute. CIT Bank's Platinum Star pays 4.1%, but and this is important, you need to maintain a $5,000 minimum balance or your rate falls off a cliff, which we will also cover. Then a bit farther down, the SOFI, the Sophie Bank, offers up to 3.8% if you set up direct deposit, and Marcus by Goldman Sachs pays a more modest 3.4%, but Marcus makes up for the lower rate with Brand Trust and 24/7 customer support, which matters to some people. Now, before you go open to all of these accounts, don't. Every single one of these headline rates comes with a catch. Let's talk about the fine print, because this is where people actually lose out. Here's the analyst caveat I promised you, and honestly this slide alone could save you from a bad surprise. Take GoToBank. Yes, the headline rate is 4.5%, but that rate only applies to first $5,000 sitting in the account. And think about that $5,000 mark drops down to a much lower base rate. So you have got $20,000 to save to GoBank. So GoBank alone is not going to cut it. You would only be earning that great rate on a quarter of your money. Now flip to that opposite problem with CIT Bank. Their Platinum tier pays a strong 4.10%, but only if your balance stays above $5,000. Let it dip below that floor even for a day and your rate collapses all the way down to 0.60%. That's a massive difference, and it can happen without even noticing if you make a big withdrawal. And the lesson here is very simple. Never just chase the biggest number on a comparison chart. Always check whether there's a cap on the top end or a minimum balance requirement on the bottom end. This single habit is what separates people who actually captures these high rates from people who think they are, but really they are not. So knowing all this, caps on one side, flows on the other side, how do you actually structure your money to get the best of both worlds? That's exactly what we are covering next, starting with my favorite strategy. So strategy number 1, what I call the barbell approach, and it directly solves the cap versus flow problem we just talked about. Instead of putting all your money into one single bank and hoping for the best, you split it across tiers based on how these banks are structured. Step 1. Take the core emergency fund up to $5,000 and park it in GoToBank. Since your 4.5% cap kicks in right at $5,000 anyway, you are capturing the absolute peak rate on exactly the amount that qualifies for it and nothing wasted. Step 2. Anything above that $5,000 mark, your overflow money route it into an account like Vault. It pays 4.34% with no cap at all. So your larger balance keeps earning a strong rate with no matter how big it gets. And the step 3, if you want a second overflow option or specifically prefer accounts backed by FDIC fast to networks, see IT Blank Platinum at 4.10% Wars 2. Just remember to keep that balance above the 5,000 floor we just discussed. The beauty of this approach is that it's not complicated. You are not managing 10 accounts, you are just managing 2, maybe 3, and each one is doing exactly which best at it. That's the barbell, and capture the capped rate at the bottom, capture the uncapped rate at the top. So strategy number 2 is a little more advanced, but yeah, it's a great option if you have got cash you don't need for a few months. I call it fine print arbitrage. So there's a network called Raisin that partners with smaller banks to offer short-term promotional rates. A great current example is Everbank, offering 4.15% guaranteed for 90 days, not up to. So 4.15% actually guaranteed for that fixed window. The idea here is that you have got a chunk of cash sitting around. Say you are saving for a big purchase in a few months, or you run a small business and have some short-term working capital. You can park it in one of these 90-day guaranteed windows, let it earn that locked-in rate, and then move it to the next best offer once the window closes. And it does take a bit of admin work. Yeah, you need to track it when promotional periods start and end, and you are not caught off guard when the rate resets to something lower. But for cash you know you will need again soon, this is genuinely smart way to squeeze out a guaranteed rate instead of a variable, that one that the bank can quietly lower whenever they want. Now, if you have spent any time looking at short-term investments, you have probably heard people say treasury bills or an ETF like SGOV pay just as much, sometimes even more, than a savings account. So why bother with a HYSA at all? The honest answer is it's really about the yield. It's more about the access to your money. A high yield savings account that's called HYSA gives you next day, sometimes even the same day, ACH transfers with no settlement delays, no brokerage commissions, and no waiting around. You can move up to $100,000 and have it show up in your checking account almost immediately. The treasury bills and the SGOB, on the other hand, live inside a brokerage account. To turn them back into cash, you have to sell them on the market and wait for the trade to settle, and that sometimes eat a small execution spread or a commission. It's not a huge hassle, but it's definitely not instant. So here's the simple rule I would suggest. So yeah, if it's money you might need on short notice, an emergency fund, money for a house down payment you are actively working toward, and think time sensitive, keep it in a HYSA. If it's money you are confident you won't touch for a few months and you are comfortable with a slightly slower withdrawal process, treasuries can be a fine complement. It's not really either or, it's about matching the account to how fast you might need the cash. Before you go move your life savings into some online bank you have never heard of, let's talk about the risks, because this part actually matters more than just chasing an extra tenth of a percent. Okay, first, FDIC verification. Anytime you are considering one of these smaller digital banks, actually check whether they are a direct FDIC member or whether they operate through a reputable pass-through network like Green FI or Rising. Either way, you want that standard $250,000 per depositor per institution protection. This takes 30 seconds to check on their website and is negotiable. Second, ACH clearing windows. Not every bank moves at the same speed. Our internal look into this found that CID Bank, for example, can take up to a full week to process an outbound external transfer. So if you have got a big purchase or a real estate closing coming up, you need to plan for the delay in advance, not discover it in a week you actually need the cash. And the third one, and this one's a bit behind the scenes purpose, fintech capital runways. When a bank offers a yield above 4%, 3% or so in this rate environment, it's compromising its own profit margins to attract your deposit. That's not automatically a red flag, but it does mean you should lean toward institutions with a solid commercial balance sheet behind them, rather a brand new venture funded banking app that's still burning cash to grow. So none of this means avoid these accounts. It means to do the same 30-second background check you would before trusting any bank with your money. High yield and safety are not mutually exclusive. You just have to verify the both. And okay, let's bring this whole video together into 4 things you can actually act on today. 1. Chase the spread. This currently more than a 4 percentage point gap between the worst and the best savings account on the market. The gap is free money that most people are simply leaving on the table by staying loyal to their old neighborhood bank. 2. Barbell your balances. Don't put everything in one account. Use a kept high-grade account for your base tier and an unkept account for anything above that. So every single dollar is earning the best rate available to it. 3. Audit the fine print. So caps, floors and direct deposit requirements are what separate the advertised rate from your actual rate. Read the terms before you transfer a single dollar. And 4. Verify before you deposit. The FDIC coverage and the ACH clearing times matter just as much as the APY on the homepage. A high rate at a shaky, slow-moving bank is not actually a good deal. Do these 4 things and you have just turned your cash from losing position into one of the lowest risks, highest rate return moves available to you right now in 2026. And that's the full breakdown of this 2026 high yield savings account landscape. Yeah, quick reminder before you go, everything in this video is based on publicly available rates and FED Fed policy as of July 2026. This is a general research and education, not personalized financial advice. So always double check current rates yourself and consider your own situation before making a big move. So if this video helped you making sense to where to put your cash, do me a favor and hit the subscribe button. I put out breakdowns like this every single week and covering rate ranges, Fed policy shifts and strategies that actually move the needle on your money. Drop a comment letting me know which bank from this list you are considering, and I will see you in the next one. Till then, bye.